better than expected December CPI print. My next guest says this morning's report could be a good sign for the months to come. Joining me now with his market outlook and his best stock ideas for this month is Fundstrat Global Advisors Tom Lee, a CNBC contributor. Welcome back.
Great to see you, Scott.
All right, first, your view right now on this market is what?
I think that markets are showing some relief that CPI was dovish, and actually I think some of the inflation prints the last 2 days have been dovish, including PPI. So it's setting the stage for yields which kind of were close to touching 5% to kind of cool. And at a time when sentiment's been negative, I think we should be rallying.
Is the Fed back in the game? Which means this report was good enough, these two reports, really, as some are saying that, okay, you're not going to get a cut in January, but you could get one in March, and some people had written cuts off for many, many months.
Yes. Into this CPI print, the whisper number for core CPI was over 0.3, so the market was bracing for a really hot number, and you could see it in the Fed fund futures where, as of yesterday, there was a 30% plus chance of a Fed hike. I think those sort of extreme views have been quelled, and I just think generally, without accounting for the fact that the California fires could mess with inflation, the inflation print over the next 3 months is going to be a lot lower than what we saw November and October. And remember, January to March of last year, it was close to 0.4. So I think inflation is setting up for some good comps.
Okay. How optimistic are you for the type of return we could do this year after back-to-back, 20+% gains for the S&P?
We've gotten some good harbingers so far because the first 5 days of this year, the S&P is positive. So I'd say there's an 80% chance of something over double digits for the year. And what's going to matter to a lot of people is how we do for the month of January. But as of January 15th, we're up 0.7%. So those are good harbingers for the year.
Can we have a good year if the Fed doesn't cut until later in the year and bond yields remain elevated for a while?
If bond yields get stuck here, it is a severe tightening of financial conditions, and I think it's going to hit housing, and we're already seeing it now. So I think it is important for yields to move directionally lower.
That's a long way of saying stocks will not be good if bond yields stay where they are now?
Yes, it's going to test the market's resolve. I don't think it kills equities, but it's hard for someone to be pounding the table if they think yields are going to be stuck at close to 5% for the next 6 months.
Wow, so if yields, let's just say they stay near where they are now, you wouldn't be as optimistic as you are?
I think it's going to raise concerns there's a policy error from the Fed, that either financial conditions are too tight or the bears will argue the Fed made a mistake cutting too aggressively last year.
But isn't this the base case? I mean, you have what is arguably a more inflationary environment because of some of the policies that are being talked about by a new administration. Sure, they may stimulate more economic growth, but with that potentially comes more sticky inflation too.
Well, there isn't necessarily a connection between growing faster and more inflation. There is some inflation that can be generated by tariffs, and that's the uncertainty.
But that's what I mean also. It's like tariffs, it's inflating the deficit. It's just reinflation. It's the reinflation trade based on some of the expected policies that may cause that.
True, but to keep in mind, last year's inflation, first of all, a lot of last year's inflation was what they call imputed because it was just statistically catching up to the price changes of the years before, but it's housing and auto insurance were 80% of the inflation over the last 4 years. And the third is labor markets, which we know aren't in an inflationary position. So in order for new policies to generate inflation, they have to be powerful forces that fiscal spending hasn't generated the last 3 years. So I'd say that it's difficult for me to make the case inflation's getting strong.
Tom Lee rethinks his Nvidia prediction for 2025, fearing he might be way off, and Nvidia might actually surpass his goals tenfold. Nvidia, which once built its empire on gaming GPUs, is now transforming its business outlook with an ambitious foray into cloud gaming. With major announcements at the CES 2025, Nvidia's GeForce Now is poised to redefine the gaming experience, leaving analysts and investors keenly watching this new dance of data and anticipation. Could Nvidia be on the cusp of capitalizing on a growth trend that challenges traditional console and PC gaming? Welcome back to Investocracy.
Tech rally happening too, with Nvidia leading the way. Let's go into the group in some more detail with Eric Lynch, Managing Director at Scharf Investments. Good macro mind, also good micro mind on the stocks. Eric, Happy New Year. Good to see you.
Yeah, great to see you. Happy New Year, Oliver.
So tell me, as we are dealing with inflation prints this week, what's that trade-off between the macro and the stock specific and the AI trade? Can AI power us through bond volatility, or will it be too much to handle?
That's the question, Oliver. Can we thrive at 5?
I like that. I'm going to steal that from you.
Last month, you've got, it's true. The 30 years has been flirting with 5%, bounced way off of closer to 4, a month ago. Same thing for the 10-year. So, obviously that puts competitiveness position versus equities and, particularly for growth stocks. So we have to see good earnings, good transfer from just inference to, from training to inference this year for, I think, the AI trade to continue working.
We continue to see reports like the one from the analysts we just talked about upgrading AMD. It seems like the market really wants this to be more than just an Nvidia story. That's kind of why we're talking Oracle and the stocks that maybe are more kind of on the software side, maybe as we shift from hardware possibly to kind of the software trade and AI. But do you see it expanding too far? I mean, the stock market wholly is still quite concentrated.
Yeah, I mean, it's still probably overvalued relative to other parts of the market that have just been lagging for years now, whether it's value or it's small caps or international. But having said that, you still got wonderful opportunities such as an Oracle, where, it was an also-ran, Oliver, for so long in cloud computing. But, it has this really great superior kind of vertical technology stack that AI was a use case that it needed. So it started with the TikTok signing, and in the last several quarters, their cloud infrastructure business has been growing at 55% roughly, multiples of AWS and Microsoft. So this is a business. Oracle's one. There's other ones out there that are benefiting from AI. The AI trade should continue to transfer to new companies. The real question is how fast and how much, and whether or not that's baked into valuations correctly. In Oracle's case, they kind of gave a mind-boggling 5-year guidance at Oracle World last September that they were going to grow revenues 16% annually until then. This for a company that was growing only 5 or 6% the last decade. So AI is clearly helping someone like Oracle.
I like a chart that you've got that shows Nvidia earnings results versus guidance and how we've sort of stabilized, but it still is regularly improving or beating the guidance. And I think that's an important distinction, because I think a lot of folks thought maybe when the first initial boom of growth peaked in terms of rate of change, maybe the stock would, but so far it hasn't. Nvidia's been fighting for highs even as the numbers become a little bit more predictable. Does that tell you that this is still sustainable, that maybe this is not a bubble in this stock, or how do you read that?
Yeah, well, for the short term, yes, it looks sustainable. The management's guiding for, a complete sellout of all their 12-month supply of Blackwell. They shut down any concerns about the Blackwell kind of liftoff, at the CES presentation last week. So, they maintain guidance, in other words, for Q4. It looks like the story is still intact. You had good, strong numbers from Foxconn, who puts together some of their servers. So, and that was just a couple weeks ago. So it looks like the story is sound short term. The question is, what do we do in the outer kind of quarters as, again, this large land grab for the training of these large language models pivots to actually commercialization and inferencing? And what type of compute power do you need for that? To date, all the GPU chips they've sold, the estimate is about 90% of those have been used for training. How much compute power do you need for inference as we make that transition? That's the question.
Nvidia's evolution over the past few years has been nothing short of a business masterclass. They faced the hard truth. Gaming was shrinking to a mere 9% of their revenue, overshadowed by the booming AI-driven data center business, which now accounts for 88% of their income. Enter GeForce now, Nvidia's ticket to a potentially massive future. a cloud gaming service with the promise of turning any device into a GeForce RTX gaming PC. This move comes as Nvidia announced their expansion plans at CES 2025, showcasing their strategic leap into cloud gaming, a sector ready to outpace the growth of traditional gaming models. But before going on with the video, are you into cryptocurrency? If so, check out our second channel, Investocracy Crypto. We bring you breaking news, expert analysis, and the latest trends in the fast-moving world of digital assets. Whether you're a seasoned crypto investor or just curious about the future of finance, we've got something for you. Click the link in the description to subscribe to Investocracy Crypto now. Don't miss out and stay ahead of the game. Now, let's get back to the video.
Seems like as we do make that transition and as the customers of the computing power devise their products and their services, that the stock again has pretty good breathing room. Just looking at the margins, I mean, this is very unique and very above historical averages for a semiconductor. It's kind of redefining the financial math behind a semiconductor. You got another good chart looking at Nvidia EBITDA margins.
Yeah, this was what gives us some pause as well. Obviously, long-term capitalism, you tend to see margins get whittled away from competition. What prevents that, Oliver, of course, are things like network effects, ecosystems, switching costs, things like that. So the thing about NVIDIA that is attractive is they do have a software ecosystem around their chips, and that's going to help protect some of those margins. But let's also be clear, they haven't had real GPU competition of any notable extent to date. And so, they've been selling these chips for 25, 30, whatever the number is, thousands of dollars. And that has amped those margins from a long-term average of closer to the semiconductor average of low 30% to really double that in the last, few years. So that's really what investors are also going to be looking at in calendar 25 is, does that margin, level maintain itself or not?
The user base explosion, from just 1 million in 2020 to over 20 million in 2022, paints a picture of a market hungry for Nvidia's offering. While Nvidia holds a commanding 90% in gaming graphics cards, this venture further cements their innovative spirit in the gaming zeitgeist. Alex Partners forecasts the cloud gaming market to jump 58% to $11.1 billion in revenue by 2025. This upward curve looks even more dazzling, with projections soaring to $140 billion by 2032. But before going any further, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
Yeah, I mean, the fact of the matter is, Oliver, despite all the wonderful kind of technologies that, AI is unleashing, and credit to Jensen and NVIDIA for their 2-decade positioning to get to this point, the fact of the matter is that we just don't know what's going to happen going forward. It's just a tough cyclical business, commodity business over time. It's great when it's great, and it's not great when it's not. It wasn't long ago in NVIDIA, its revenues were way down and the stock crashed. I'm not saying it's going to happen, but that has been the unfortunate historical pattern of semiconductors over time.
Eric, give me a sample of what your conversation with clients is like when it comes to NVIDIA concentration risk for the indexed investor. How do you protect or hedge yourself against a highly concentrated market that we're in?
Yeah, well, that's a great question, Oliver. Look, these are great companies. Our feeling is you want to have exposure to them. However, a lot of investors don't realize, for example, if they buy a passive index like the S&P 500, just the top 10 market cap stocks within it are now almost 40% of the index. So it's not 500 kind of diversified exposure, to businesses. And NVIDIA is one of those that comprise a large chunk of that 40%. So great business, but it's probably a larger chunk of people's net worth than they realize. And so therefore, it could be a time to, sell some of that, or trim some of that at least, and reallocate to things that have really not participated for a long time, that have good valuations, still good earnings growth. We think it's important to look for good quality businesses. With interest rates increasing, inflation still high, the rest of the world not doing so great, as exceptional as the United States is, there are some downside risks there. And so it's important still to kind of balance, optimism and prudence.
As we stand on the cusp of a gaming revolution, Nvidia positions itself brilliantly within this growing narrative. With a holistic view of gaming's future tied to technology and AI, their expansion into cloud gaming marks a strategic inflection point filled with promise and potential for accelerated growth. The stock flaunts a promising trajectory, bolstered by its cloud gaming advancements and AI prowess. So, what are your thoughts as Nvidia leaps into this brave new world of gaming? Could this be the golden era for investing in gaming technology stocks? Let's hear it. And finally, if you would like to know what companies like Nvidia have been up to these past few days, go ahead and click on the next video on your screen. See you there.